We've got some attendees coming in. Welcome. All right. Thanks to those of you who are joining us here. We're going to let everybody come on in before we start the webinar. And we have a whole bunch of people joining us, so it'll take a moment to get everybody in here. Sorry for starting late. We were working out some of the technology part of this.
I will say, while people are coming in, this is by far one of the most attended webinars that we've had in Omega history. So clearly we have struck a chord, Lisa.
Clearly we have. And while we're having everybody join us, this was probably one of the hardest webinars to prepare for because stuff keeps changing. So I hope you'll keep that in mind and bear with us. We're going to do our best to try to cover a number of topics that we've heard about from our clients, and certainly happy to follow up afterwards. So I think we've got a lot of people. I'm sure we'll have some more people joining us in a minute. I'm going to go ahead and start some of our slides. Jared and I are going to both be sharing some thoughts here on different topics. Again, thank you for joining us today. And let me go ahead and get the slides started. We will send the slides out afterwards, so that's the other thing. And we have another handout we will be sending as well. I'm going to go ahead and actually start here. Okay, great. So we went back and forth on the title on this, navigating the uncertainty of political and economic shifts, what to do next. We know people are wondering what they should do. We'll talk a little bit about maybe what you should do and what you shouldn't do, and try to not just cover the market side of things and even economic, but personally how you can navigate what feels to many, I think, like an unprecedented time of unknowns and change. Actually, we've talked about this several times on our team, and in some ways it feels a little bit like what we were all going through in the pandemic 5 years ago, almost to the month next month. And for some of us who've been around a little bit longer, it may feel a little bit like 2008, 2009, just with nonstop headlines and news coming at us. So we needed to start with something on the lighter side here. Obviously, as far as the scope, we're going to do our best, as I said a few minutes ago, to cover some of the key concerns, key questions that we've heard from a number of our clients. But there are still a lot of unknowns. Different people have different concerns depending on where you are in the cycle of working, preparing to retire, maybe being forced to retire, maybe being long time in retirement. We are seeing different concerns from different clients. We are in the middle of many court challenges right now, and we don't know how many of those are going to turn out and then what might happen after that. So please bear with us because we're going to do our best to help perhaps you navigate this a little bit better going forward. And the other thing to keep in mind is, as we're already seeing play out, there are a number of unintended consequences as well as intended consequences coming out of some of the changes that the administration has put forth. And that all will have to play itself out probably over a series of months before we really know how the economy may be impacted or how the markets may be impacted. But in the meantime, enjoy your lavender stress reduction.
Lisa, do you want to tell people about the Q&A that we talked about?
Yeah, we will try to take some questions as we go along. If we're getting to the point where we feel like we can't get through the end of our materials, then we are going to ask you to pause till the end, and then we will be happy to answer any and all questions that come up. Thank you for that, Jared.
I'm trying to man the Q&A as things come in. So if you have any questions, the bottom of your screen should have a Q&A box. Feel free to send those in and I'll I'll try to curate them for Lisa to answer.
And likewise with
Or
Jared.
at least give her opinion. I don't know if we have any answers, but we have opinions.
Oh yeah, we definitely have opinions. So the first thing that we want to talk about, because Jared and I are certified financial transitioners. Actually, Jared and I, Davis and Saki are all certified financial transitioners. We are trained and skilled to help people navigate transition and change. And I think this is a good time to normalize perhaps what some of us are feeling at this point. So there was a lot of anticipation leading up to the election, what might happen, what might come into place. And then we got to the point on January 20th where the new administration took their place. And since then, I think you would have to agree that many of us are in what is called passage. And please note that we are not quite in the new normal, although it may feel like it to all of you. For some folks, they may see this as possibilities, the opportunity to right size the government. For other people, there's a lot of fear. We have some federal employee clients. There is chaos, unknowing things being put in place, things being taken out of place. And so I think the first thing to talk about is just that we are in a big transition. It goes in stages. And what you also might be feeling is what we would call the characteristics, maybe especially the struggle characteristics of transition. Perhaps overwhelm, confusion, a little bit of hopelessness, some fatigue just with the pace of communications and updates and headlines. Some of us may just want to put our head in the sand and hope it's going to be over soon. You may be focused on a particular issue that is important to you and your family, or you may be all over the place. And so, what we want to, well, and I guess I should include combative too, for some people. I think the important point here is there is a financial side. We're going to talk about that today, but there is absolutely an emotional side. And that is valid. And we are going to talk a little bit about what are some of the things to do or not to do to help deal with the personal side of the transition, the uncertainty, and the potential changes that we're all facing. So you'll notice a quizzical look on this guy's face. There are a number, there's about 4 different categories of issues that have come up quite a bit with our clients. The first one is what's going to happen with tariffs? How does that impact inflation? And then consequently, how does that impact interest rates? I think it's fair to say, there may be revenue that comes with it, but tariffs are generally considered by most economists to be inflationary. There has recently, in the last week, been some talk of whatever Doge is able to collect, take back in. This is not on the tariff side, but if the government is able to take back in revenue, might they distribute that to taxpayers? That's not really going to help with the other issue that isn't exactly on here, but I'm sure is on many of your minds, which is what's going to happen with the deficit. And with tariffs right now, we don't know exactly what's going to happen. I think the only tariffs we have in place are China. There are today, even at the cabinet meeting, there was a little confusion about when Canada and Mexico might see their tariffs. There's a threat for the EU as well. A lot of this is being used as a negotiation tactic, but if they are put in place, it's fair to say that they are more likely to be inflationary. And when it comes to inflation and interest rates for the Federal Reserve, that was on track, which we'll come back to this when we talk about bonds, was on track to cut rates last year. They are now in a position where they are going to want to wait this out to see exactly how some of the administration's policies actually play themselves out. The tricky thing that the Federal Reserve now faces is based on some of the policies that are being potentially put into place. If we start to see a situation, and we're already seeing some layoffs, not just with the government, but with corporations, if unemployment starts to increase, Normally the Fed would want to cut rates to try to stimulate things. But if we're in an inflationary period of time, that's exactly not what they want to do. They don't want to lower rates. In fact, if inflation is high, they tend to raise rates to cool the economy off. So it gets a little complicated for them, and they're normally reacting to past news. They're not normally reacting to what's in front of them. And so this is I wouldn't want to be Jerome Powell at this point, because they're going to have to try to look ahead while also responding to what has already happened, but not too much, because that's old news. I think it's fair to say everything that we're reading is that rates will stay higher for longer. So any cuts that we anticipated last year, at this point, unless the economy really takes a hit and isn't overly inflationary, we are probably not going to see rate cuts, very many. I think what the Federal Reserve, Jared, has said, maybe two,
Yeah.
maybe two. And at this point, that may be a big maybe. The good news is, and this will be what can you do, is obviously right now that means the cash interest rates, money markets, high yield savings is probably going to stay about where it is. And so that's actually an opportunity if you are sitting on cash or you want to be sitting on more cash at this point. So the next issue, and this one, I'm not even sure I can keep up with it right now, so I'm not even going to pretend to. Um, the House is trying to pass what the president has asked or has labeled a big, beautiful bill. They took a shot at it last night. That the House and the Senate are trying to go at this two different ways. That the Senate is trying to focus on border security and military spending. The House is trying to get a one size fits all bill together. But what's in play here is one of the big things. So there's like three elements really: spending cuts, tax cuts, and then there obviously are things that they want to spend money on as well. So there are cuts, there are places to spend money, but then there's also potentially tax cuts. So just as a reminder, almost 8 years ago, 7 years and a few months, we had the Tax Cuts and Jobs Act of 2017 during President Trump's first term. Now, there are the way they write these bills, they often have expirations. So we are coming up on the year of expirations in 2025. And so there are some things that if they cannot figure this out, if they cannot get some of these tax policies that were put in place in 2017 to be permanently extended, then we are going to see some changes. Some of them include the top income tax rate moving from 37% to 39.6%. The state and local tax deduction cap. That's like your state and local income taxes, real estate taxes, that kind of thing. There is a cap at $10,000 a year on the Schedule A of your itemized deductions if you itemize. If we cannot extend that, then we would many of us would get to take a bigger deduction. There is talk about extending or making at least the cap bigger, if not letting it go, but that's a very political charged issue. For business owners, and we have some of our clients are business owners, there is a special pass-through income deduction that would need to be extended. If it's not, then that goes away. There's a difference in mortgage interest deduction. It's currently held at, depending on where you live, $750,000 of a mortgage loan interest can be deductible. That would pop back up to $1 million, which some of these, I'm sure some of our clients would be happy to see not get extended. The one that we've got a lot of clients who are charitably inclined, cash deductions have been more valuable over the last 7 years. Potentially, they would become a little less valuable, or you wouldn't be able, it's not that they're so much not valuable, but you wouldn't be able to take as big of a deduction for cash deductions, charitable contributions in any one tax year. So there's a lot of things on the table. Oh, and the last one being the estate tax exemption. I think given who is in power at this point, we would expect to see that we would keep the higher 3.7, 3.9 million per person estate exemption. But the devil is in the details on getting this bill through and getting it reconciled with what the Senate is working on. So the bigger challenge that I think we face is, at least at this point, spending cuts plus tax cuts don't get us to a balanced budget, to a surplus. They leave us with a deficit. And I know, again, today, hot off the presses, the president said in the cabinet meeting that he wants to get to a balanced budget in the next 2 years. The one thing you should know is for anybody who watches modern monetary theory, getting to a balanced or surplus budget is not necessarily good for individual taxpayers. And so that's something, I don't know, we may end up talking about soon if that's the direction that the administration goes. But for the moment, the math isn't quite working. And where the politics come in is that there are a number of, especially House Republicans, who are concerned about running deficits, and that can have an impact on bonds and our ability to obviously to support the interest payments on an ongoing basis. And so there's a lot at play. Stay tuned. This is obviously moving on a day-by-day basis. One of the other issues or concerns that we have heard from a number of clients that I think is worth talking about for a moment is the future of Social Security. So just as a reminder, it needs reform. We all know it needs reform. The last time it was reformed, and I'm going to completely date myself here, was 42 years ago. So you can all do the math. And keep in mind, for those of us who, like me, was impacted by it, they put those reforms in, including extending the full retirement age from 65 to 67 over a 20-year period. So younger people were definitely impacted. But people who were at Social Security age were already taking benefits were not impacted.
I think it's
Yeah, go ahead, Jim.
important just to add that when Social Security reform last happened, only individuals 45 years old and younger were impacted. So if you were over 45, not even if you were already taking benefits, if you were over 45, you were not impacted the last round. I know that's not, you can't base, future off of historical performance. That's a big line in our industry, but I think it's important to note that the closer you are to being able to take Social Security benefits, the less likely you're going to be impacted.
And by the way, generally the older voters tend to come out in droves, and for something like this, are going to come out for it. The other point is often we talk about the Social Security Trust Fund or trust funds running out, and I want to just make sure that we all understand what that means. That doesn't mean when they run out in 2034, which is I think the year that is being anticipated, that Social Security stops. What it means at that point is that there's no reserves. There's still Social Security or FICA taxes being paid, benefits going out. The problem is there's just not enough taxes coming in to offset the benefits being paid out. So the trust fund running out doesn't mean no money, but it will force reform if we haven't already figured it out by then. And I think the normal themes as far as reform include raising the full retirement age to 69 or 70, higher Social Security taxes, although I'm not sure that's going to be popular right now, means testing of Social Security benefits. Now, of course, one of the things that's been proposed in the big, beautiful bill is zero taxation on Social Security. That is not going to help us here. I
Well,
hate
I
to
think it will expedite the need for reform, if anything.
Exactly. Now, if you're receiving Social Security, like my husband is, well, I'm pretty excited. We might get more money in our pocket, and that's actually at the heart of a lot of what we're dealing with here. Is it's complicated. With and we're going to talk more about it. Stock market hasn't gone down yet. Um, Gee, maybe you won't have to pay taxes on Social Security, and yet the bigger issue is, I think, what lies ahead. There is one other issue at the bottom of this page that I do want to talk about, and it's going to be part of our action steps at the end. We have a whole list of action steps. So you need to stay tuned and stay for the whole webinar. Um, and that is that there has been some concern that the Doge folks have had access to the Treasury payment system, to the IRS. And if you are concerned about that, there is some action that we can talk about around that, because we don't know exactly who might have access down the line. If you're and for anybody who's already had their identity compromised, and I know there are some clients where that has happened, there are some things that you may want to consider just in case, at least to be able to monitor. You may not be able to completely protect, but if nothing else, be able to monitor and quickly take action.
I've got one more on Social Security.
Let me get back.
So, and you might be the best person to talk about this, Lisa, but do you want to talk about once you're over full retirement age, how you're able to get a look back or a lump sum of benefits? I know you and Jim sort of work through that math, and that may be a possibility for clients if they're over their full retirement age, for many people, 66 and change or 67, what they have available to them if it looks like there's going to be some adjustment to people's Social Security benefits.
Yeah, and well, I'm gonna save most of it for the end when we get to the action steps because it's on the list.
Okay.
But you do have the ability once you're, I mean, even if you're not at full retirement age, but we'll talk about, why would you take Social Security benefits sooner? Um, you can go ahead and file, and then you can ask for a 6-month look back. Now, that means that they will date your benefits back 6 months. So it will be a lower monthly amount, but then they will send you 6 months worth of benefits. So that is something to consider. Let's not all run out and do that all at once because we'll crash the Social Security website probably too in the process. But that is something to consider. But I want to talk about that more when we get to action steps, as far as how to think about that. What are the reasons to go ahead and ask for the check? What are the reasons to maybe hold off? And then obviously what we've already alluded to is you have the ability to basically retroactively start claiming benefits, maximum 6 months back. So thank you for that. And Jared, with that, let's head over to talk a little bit about the markets at this point.
Yeah, so we did have some debate about including this slide. It's not meant to be partisan, so let me caveat that first. But let me just talk for a moment about consumer sentiment. And what we're seeing here is consumer sentiment by party leading up to the election. And you'll notice on election day, Trump wins. Republican sentiment goes up. Democrat sentiment goes down. This is not unique to this election. It's actually a cycle that has continued on for the past 8 or so transitions from one party to the next of who's in the White House. So I think the point is that a lot of our view about the economy, about the markets, can be colored by our beliefs politically or our beliefs about the world as a whole. And it's important to note that the market and the economy are separate from politics. One of those instances that we saw was during COVID. Many of us experienced the cognitive dissonance of the market rallying right at the peak when people were dying. And it's just an uncomfortable situation to be in, sort of experiencing that distance between the market and what we're experiencing in our reality. And this is not to say this is all imagined, that this is all in your head if you're worried about it. It's real. There are some concerns to be focused on, but I guess the point of this slide is be aware of your how you view politics and how you view the economy may be impacting some urge to take action. And we're not saying don't take action. There are actions that are helpful, and we'll talk more about that. But we want to give you the autonomy to make the right action and give you the control of making the right action. Anything you would add, Lisa?
Yeah, well, I want to add that this, you'll notice the slide stops at November 11th. We've got new consumer sentiment numbers out. They are not very positive at this point, not surprisingly, because now the administration has taken over. We've actually seen some things go into place. There has been some chaos, especially if you are in the DC area and you're anywhere related to federal, the federal government, federal workers. So and that's the challenge we are facing. I got to tell you is, all right, so this is November 11th. It might as well be 2 years ago to some extent, just at the pace at which news is coming at us. So we do get it. Sentiment is down even further, and yet the market is still up since election day, which we can talk a little bit about.
Yeah, there was a great article this morning in the Wall Street Journal by Greg Ip. I think we could probably send that out as part of the resources following today, just talking about sort of this continuation of a trend. This has been going on for a while. Objectively, the economy is in a very strong spot. Unemployment is near or at record lows given the month. Wage earning has increased. Spending is high. Debt levels are low for consumers. We are objectively in a very strong place economically. Yet many of us feel like, and we can personally feel that of our own financial situations. Oftentimes we feel like financially we've never been in a better situation. But when I look at the economy, all I hear is negative headlines, and I view the economy as being negative completely. You see it every day with headlines about egg prices, inflation coming back. There is this ongoing trend of people feeling really good about their own personal situation, but the world is going to hell, for lack of better words, economically speaking.
Well, and the future. I think where the focus, the negative sentiment is focused at this point is actually looking forward, not right where we are today.
Yep.
And
Yeah.
that's hard to predict, right? I mean, we know where we are today, hard to know where things are going in the future. And that's the other piece I think that Greg Ip talked about in his column.
Yeah, and sentiment is important. It is a leading indicator for future spending. They talk about that in economics class all the time. There are leading and lagging indicators. Future sentiment is a leading indicator, and like Lisa said, we've seen a dip in sentiment over the last several weeks as inflation has appeared to remain sticky. We're expecting to see larger unemployment numbers given what has taken place with the federal government. So all of this is in motion. I don't know if there's much else to say other than it is happening right now. Things are good, but that doesn't mean things will remain good.
Well, and the other thing in the Wall Street Journal today was that honestly, most of the people who are on this call are the key to spending and consumer sentiment.
Yep.
The wealthier folks are the ones who are still spending. If we stop spending, then probably the bottom's going to fall out. So then sentiment becomes important because if we think things are going to be more inflationary, sometimes that's a self-fulfilling prophecy. Or if we get nervous about spending, then as a herd, we all become concerned about spending. We pull back, corporations get into a difficult position. And so all these things sort of build and are interconnected with each other. And yet sometimes it's very hard to know how they're going to play out. It can seem really clear, but it doesn't always play out the way we think.
Yep. Exactly.
Should I go to the next slide, Jerry?
Yes. Yes.
Okay.
So overall, markets do not like uncertainty. I don't know anybody that really likes uncertainty. Corporations don't. People don't. I don't. We all don't like uncertainty. It's not a fun place to be, and that is certainly what we're all feeling right now. Will tariffs happen? Will they not happen? What's going to happen with geopolitical risks? Who knows? I certainly don't know. What's going to happen with taxes, like Lisa was talking about earlier? I don't know. Nobody knows. Attorneys and accountants will tell you they don't know. They don't want to give their opinion because they don't want to be held liable for any actions that get taken. So Lisa and I are regularly watching webinars, going to conferences, we're talking to estate attorneys and accountants all focused on these issues. Nobody knows. It is super uncertain right now. And part of what we're seeing is volatility. But volatility is not always downside volatility. We've seen big up days in recent days. Actually, the stock market is up. I don't know if you have the exact number that we looked at, Lisa. It's somewhere around
Three and a
3.5%.
quarter. Yeah, 3.25 since the election.
So since the election, despite all of the headlines that we've been seeing, the S&P 500 is up 3.25%, which creates a lot of cognitive dissonance for people. We're seeing headlines that are objectively scary. All this uncertainty, here we are saying the market does not like uncertainty. There's this belief that if all this goes through, it's going to be bad, but yet the market is rallying. And this is not the first time that's happened. I talked about COVID. It happened in the 1950s. It's happened throughout history. One of the things that we often hear from clients is that I don't have the runway to recover if we do experience a downside shock. And that is very true. And it's going to show up in our recommendations at the end of the slide. But we want to be working with all of our clients. We get flack for this, but we say it every time. Let us know your cash needs because we want to make sure your cash needs are well protected. Um, Anything that you know that you will need to spend in the next 12 months if you're retired, could be longer. Really, the answer to this is how much cash do you need on hand to make you feel comfortable? That is something that you have control over. You do not have control over what the S&P 500 does. You do not have control over what happens in the White House. We do not have control over tax law and what happens there, but we have control over how the portfolio is allocated. We have control over what we've set aside to protect. We will encourage you not to move to cash and not to move too conservative because we want to be thinking long term. In this graph, we're showing you there's a despite, and this goes back to the Great Recession. This is the last 100 years of market performance. So you can see all the way back to the Great Recession, big declines back in the 20s and 30s. And hopefully we're not going to experience that. But again, we don't know. We could experience something like it. It's certainly possible. It's in the realm of possibilities that we experience something like that. And there's not much control over what we do other than how do we position your portfolio so that you feel confident about being able to survive whatever comes next. So if you are concerned, this is not a conversation that we can have at a webinar. This is a conversation that we want to have with you and all of our clients individually. And we try to have this conversation at all of our meetings. But if you're feeling worried, concerned, wanting to make a change, we are available. We at Omega work with 106 client families now. We work with 106 client families. There are 4 advisors at a team. You will be able to talk to somebody no matter what day or time it is. Maybe not Saturdays and Sundays, but if you give us normal working hours, we will be available to talk with you and walk through your concerns. We may not be able to allay your concerns, but we can help you take control over what you have control over. So anything you would add to that, Lisa? Oh,
Yeah, there's
I missed unemployment.
Well, yeah, I mean, and we don't know. I mean, certainly, I think we're going to see more unemployment, certainly in the DC area. That's going to be, I think, an impact. But I want to go back to volatility, just for a moment. We actually see an opportunity in volatility, and that is, we can see, and we've seen this in past years, when the markets are moving up and down a decent amount. We have the opportunity to sometimes do tax loss harvesting, which helps offset gains on other investments you have. Can be an opportunity if we need to do some rebalancing. And I would say that is absolutely an opportunity. When the market is just moving straight up, there's not a lot we can do. And, everybody gets frustrated with taxes on your gains at some point. But that is the silver lining in what is a volatile year. Volatility, as Jared said, does not always mean we're going down. Now, I will say one of the things I noticed on this chart, and I'm sure some of you who are students of history will notice as well, is that we have not had a big recession, a multi-year recession for a while. That little line you can see is, I believe, COVID. And that is, that is something, or even 2008. Let me look at that again. I think
That's
that
COVID.
that is COVID.
Yeah.
And so fair to say that we may be overdue for a recession. But what I would say is, going back to 2008, 2009, if let's say you got nervous in February of 2008, which would have been when Bear Stearns went, they had to rescue Bear Stearns, and that whole that was sort of the beginning of the end that went on for the rest of the year. It was quite a year, and you decided to take your portfolio to cash. The problem is the same fear that gets you to take your portfolio to cash is also what's going to keep you from getting back in at the low point, which turned out to be March of 2009. And
Yeah.
so that is something to keep in mind, that fear that makes you want to jump is also the fear that is going to keep you from doing the smart thing. And that means you have unsuccessfully timed the market. And that's what we want to help you not do, is get the market timing wrong. But we are very sensitive about how smooth of a ride we can make it for you. Can we support your cash needs? Can we support your other goals? And it is not a one size fits all. As Jared said, each client has different concerns, and we will talk about that at the end. And so there are different actions for different concerns. There isn't one blanket thing. The other thing I will add, just for fun, just so you know that I'm thinking about the worst, is I went back and did a little research to see what were the best strategies in retrospect in the Great Depression, not the recession in 2008, but in the Great Depression. And there were two winning things in general. Well, three really. Number one was if you shorted the stock market. Do not recommend that. That's probably not going to work out. And the only people who were able to do that were very, 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 very wealthy people that you would know all the names of. Number two, if you invested in government bonds, because again, remember, if you had money cash at the banks failed, but government bonds survived. And then the other thing was high quality companies, the stocks of high quality companies, not overly leveraged companies. And so that's just something to keep in mind. Now, what do you do with that? Well, most of our clients are well diversified across bonds, across cash, some of which is protected, some of which isn't, depending on where it is. And then US companies, many of which are strong. And so that's something to keep in mind. Diversification is really the key once you've taken care of the short-term needs.
There's another point to this that I think is important. Um, we've talked a lot about the negative, the risks to the downside. Lisa is exactly right. We have not had a recession in a long time. Last 2 years in the S&P 500 have been 20+% returns. We will not continue to go up and up and up. There is risk to the downside, but there is also a possibility that the market continues to rally. There's nothing evident that is present right now, and there never is leading into a recession. But right now, there's nothing to suggest that we're headed for a recession. Everything right now tells us the economy is strong. If anything, we can't lower interest rates because the economy is so strong. There is the belief that we will see deregulation for corporations. We will see lower tax rates for corporations. Historically, those things have been positive for the stock market. There's the risk of inflation. The best performing asset class actually in 2022, when inflation began, were stocks. So there is a very real possibility that the market, despite some of the headlines and the concerns and everything that we're talking about on this webinar, all of that could be true. It could happen, and the stock market could continue to rally. And that's a very real possibility. And we've seen it. We saw it the last Trump presidency as well. Leading up into COVID aside, we saw positive, very large returns in stock markets during his tenure. So I just want to balance that. That's why we are not recommending major changes to portfolios. We want our clients to be able to sleep at night. We want them to feel confident about how they're positioned, but we don't know. There is risk to both the downside and the upside. Lots of uncertainty, like it says here. Volatility could be both positive and negative. Nobody knows. So we position portfolios with that in mind. Um,
Yep.
Anything you would
Uh,
add to that point, Lisa?
Yeah, I mean, I think, for all of, at every meeting, we pull out the pools of wealth diagram. We talk about the current lifestyle goals and needs, and we invest that money much more conservatively than the money that we expect that you're not touching for 5 or 10 or 20 or 25 years. And, this is certainly a year where, we will continue to, if you've got to take money out of your retirement plan accounts, we want to make sure that is sitting in cash. But, and the way we have set up portfolios is exactly because of what I went through with clients going all the way back 25 years ago, 2001, 2002, 2003, is just understanding how we need to structure portfolios to navigate short-term volatility. So there's not a new playbook here. It's the same playbook. But as you are in different seasons of your life, we need to have different amounts of money in different buckets or different pools. And we are absolutely prepared and have already done that for most of our clients. But certainly welcome the conversation to revisit how much is where. We want you to keep pace with inflation. Having some money in equities is important to keep pace with long-term inflation. Obviously, inflation is an issue that we need to be concerned about right now. So, not big changes. There are tweaks we can make around the margins that we think are useful. Again, we'll talk about that in just a minute. So, Jared, do we have any questions? Because we're going to shift to a little bit of, what can you do at this point? We have questions or comments, maybe.
One edit to what I just said, actually. I said 2022 stocks were the best performing asset class. I meant 2023. Stocks were not good in 2022.
No.
2023, when inflation was becoming more entrenched, that's when we started to see stocks perform very well. I think, one question that has come up that's worth addressing. We've certainly talked about this behind the scenes, Lisa, is all right. I get that historically the market, I see it here, it's up and to the right. What if that doesn't happen this time? How should
Right.
I how should I approach that?
Yeah, well, I mean, I think what's more likely is what happens if it's the Great Depression, right? I mean, where it's not a relatively quick blip here, that in fact it is a multi-year down market cycle, and I'm already in retirement and I don't feel I have a long runway. I think that's a risk, right? That is a risk. The chances that if we're worried that the stock market is going to go down and never recover, we have some really big things to think about. What would have to happen for thousands of companies, and I mean, or at least the stocks of those companies, to go down and never recover? That's a world that I don't think anybody really knows what to do with. I think what is more possible is, what if we had a multi-year recession, 2001, 2002, 2003, or 2008? What if it's multiple years? Yeah, that is hard. Um, and so that's why we need to be talking with you about what your needs are, depending on where you are. If you're still bringing in earned income, probably not as critical. If you are not bringing in earned income, then we need to be talking about your asset allocation. We need to talk about how much you have in cash. We need to talk about any sort of financial and life decisions that you're making. So yes, there are things to talk about. But I do think, like, the idea that we would just have this chart go all the way down, never recover, that is an existential crisis that probably there's a lot of other things that you need to be thinking about besides your stock portfolio, what it would take to do that.
Yeah, and I mean, the people on this call will probably be the least impacted out of all of society, which is it's a reality, and people without assets will be hurt much worse if that does happen.
Absolutely. And we'll talk about that at the end. What can you do? Like there, when you look around, where are places where you can put your energy? And so we really do want to talk about that a little bit.
Yeah, I think we have a worksheet coming up that we
All
can.
right. So but before we go to that, I want to just set the stage for to shift gears from, okay. Oh, by the way, are there any other questions or comments though that we need to address before we go to this?
Um, just about we have one client who is currently in Europe and asking should they buy products there versus coming back to the US? Is inflation expected to be ultra high? I don't think so in the near term. So if you find any good deals, if you find anything in Europe you can't buy here, definitely buy it and bring it back. But I don't think your normal everyday goods will be any more or less expensive in
I
Europe
mean,
versus the
who
US.
knows, right? Because we don't
Yeah,
know which
who
tariffs are
knows?
going to get put in place. I mean, I think it depends on the kind of products you're buying. That is tricky. And then you've got the currency issue as well,
Yeah.
right?
Yep.
All right, so let's shift gears a little bit and talk about what are some of the things that we do think, because part of our debate has been internally at Omega. We know from experience and from history that sometimes when things are so uncertain, you feel compelled as a human to take action. And yet, maybe the best thing to do is to not take action. But that's really hard sometimes. And so, what we've tried to do is to come up with a list of what are some of the things that maybe you should be considering or you might want to take action on, depending on your circumstances, that would be productive as opposed to ones that wouldn't necessarily be productive to your long-term welfare. So we're going to focus on that. People may have some other ideas as well, but we'd like to dive into this. So please don't worry about the chart on the left-hand side. We're going to actually send this out, and Jared's going to flip to it in just a second and walk through this exercise just to get you thinking about this. But the most important thing that we've been asking clients, which will come out on the exercises, what are you concerned about? Again, it is not a one size fits all situation. If you are retired, you may have different concerns than somebody who is an active federal employee or was an active federal employee who has lost their job, is about to lose their job, and is only 45 years old. And so we have to get to the bottom of what are the risks for you? What are the concerns for you? And from there, develop a strategy and a plan that works and will support what you are most concerned about. Jared's already alluded to this, and that is focusing on what you can control, worrying about things we cannot control is after a while is very tiring. Goes to the fatigue characteristic I talked about earlier. But there are things we can focus on that you can control. How much you're getting paid on cash, how much money you spend, or what cash needs you may have coming up. Your personal health and your stress level are things that, to some extent, with different kinds of strategies, you can manage. And then also family and legal considerations. And I want to say this very seriously. We have clients who have reason to believe that either family members or even for themselves that they are at risk. And we take that very seriously, and we are working with those clients to figure out what is the best strategy and to help support them financially and personally, or to put them in touch with the right people who can help legally. And so we do take that seriously. And those are places that you might be able to control, but it may mean that you've got to take action. There may be some trade-offs. So focusing on what you can control makes a lot of sense. I'm going to stop sharing, Jared, and let you share this tool. And again, we're going to send this out to you.
Yes. So there's a good quote. I have been a lifelong sufferer from anxiety. There's a good quote about anxiety that it is our overestimation of the problems that will happen and our underestimation of our ability to meet those problems like we have in the past. And one of the best antidotes to fear, uncertainty, anxiety is taking action in some way. Even if you're not getting results, having some sense that you are on a path towards a better place, that for most people will relieve a lot of stress and uncertainty. So this first question, and I want to attribute this Omega did not design this worksheet, and it comes from strategic coach Dan Sullivan. He's been coaching entrepreneurs since the 80s. So this is geared primarily for businesses, but it applies, I think, to this situation beautifully. So where are you experiencing overwhelm, confusion, or bother? I like that one because there's a lot of things that are bothersome these days that are holding you back from progress or momentum, or I would just add peace of mind right now. So where are those complexities? Where are those areas of uncertainty right now? The next piece is critical. So what of those worries is actually inside your control? What do you have control over? Like I mentioned earlier with the market, we can't, as much as at Omega we would love to, we cannot control the performance of markets. But we can control how we're invested. We can control how much cash we have on hand. So that's one example. Um, Actually, I'm sorry, I skipped. That's within your control. First, list out all the areas that are outside of your control. And there's a lot. Can't control policy, can't control global stage, geopolitics, can't control a lot of those things. With stuff that is in your control, what is an action you can take? And Lisa said not taking action is tough. I would argue not taking action is action. You have the autonomy to choose consciously not to take action. That, in my opinion, is an action. And then this last piece is engage your core. So, what is at your core? What are your values? What are beliefs? What are habits? What are the relationships that you can lean into during times of uncertainty that help you feel good, feel like you have a support system and people and resources there to tap into no matter what circumstances. We can never guarantee that things are going to be okay. Nobody can. But we can guarantee that we will be there to support you regardless of whatever happens. So some people it's, connecting spiritually through churches or other spiritual practices. For some people, it's physical exercise being a really great way to relieve some stress, connecting, leaning into relationships. All those things are engaging your core and taking some of those actions. I know there's some other action steps on the next slides that sort of get at this, but this to me is a great way to sort of work through some of the fears and uncertainties that we're all experiencing right now.
All right, so we're gonna go back and I'll go to the next slide. Hold on. Oh, I think it's sitting. Are you still? Yeah. Okay. So, what are some of the other things to think about to maybe take action on? Obviously, for all of our federal employee clients, we've already been in touch with many of you. We really need you to stay in touch with us. We're certainly trying to keep abreast of what's happening. We want to help you figure out what your options are. And we understand that some people aren't necessarily working for the federal government, but are impacted by changes in government funding or work for a government contractor who's now going to be impacted. So whatever your situation is, if you are feeling concerned about what's next for you, we would love to be able to talk with you, and to Jared's point, really have a game plan and a plan B should we need to implement. And actually that's something, a story I like to tell that's probably worth mentioning here. I've told it more recently to the team, is that back in 2008, the weekend before Lehman Brothers failed, um, PIMCO Investment Management, their well-known bond manager, they pulled all their people together for a weekend retreat to try to figure out what do we do next. And what they ended up doing was going through a series of stress testing scenarios. Well, what if this happens? What if somebody else buys Lehman Brothers, or what if, they have to downsize, or, so they went through all of these different scenarios of what might happen. As it turns out, the one scenario they did not think was possible is that Lehman Brothers would go bankrupt, that the government would just walk away. All of the Wall Street banks, unlike with Bear Stearns, would just walk away. Um, but the fact that they had gone through the exercise of stress testing and scenario planning and had some different actions they would take depending on what happened meant that on that Monday morning, when Lehman Brothers went bankrupt, they were 2 steps ahead of everybody else on Wall Street because they had gone through the planning exercise. And so that might be a very valuable process for us to talk with you about is, well, what if this happened for us? What if that happened? What if this happened? What would be the action we would take? We're not going to take that action right now, but we have a plan. And so that's really what we want to help you do, is to be flexible and resilient. People who are flexible and resilient, to Jared's point a little earlier, have the capacity to navigate through uncertainty and extreme change. I
Touch that.
allude,
One thing that you can and should do if you are not a federal employee and have federal employees that reach out to them, give them a hug. It is not fun right now. We've heard stories from our federal employee clients. So check in on them. That's one thing that you can and should do.
yes, thank you. Bullet number 2, as I alluded to, considering some identity theft protection, not just for you, but also the other people that I worry about are on the younger side, adult children who aren't pay, or even under 18 children who you aren't even thinking about their identity and their situation. But if they have a social security number, if have you have received any federal benefits, even for minor children, that might be a consideration. And then for those who are over 18, I've got a resource at the very end. We recommend LifeLock. Many clients have, maybe through their credit card, some sort of credit protection or identity theft. Make sure though, whatever you purchase covers all 3 credit reporting agencies, because if it's only covering one, you could have some breach at a different on one of your other credit scores and not know about it. So something like LifeLock, and you can get family protection. And the other additional benefit of working with them is if something goes wrong, they will be there to help you unwind, or to rebuild whatever has happened with your identity or credit situation. That's part of what you're paying for. So it's worth looking into. Nothing is foolproof at this point. The best thing to do is to monitor, or to have these kind of services, to think that you can freeze your credit, but then there are trade-offs when you need to use your credit. That's certainly another option, is freezing your credit, but you need to do it at all 3 agencies, not just at one. Number 3 is a way to take action. God knows if it's going to help right now. Depends on where you live and who your congresspeople are. But taking some action and expressing your frustration, expressing your concern, is a way to channel that energy, I think, for good. I think even more positively is volunteering within your community. Just to give an example, I'm now on the local board of the Arlington Free Clinic. One of the things that they are increasingly worried about is that their patients are not going to feel comfortable showing up at the clinic. They have volunteers who will go out and bring patients into the clinic. That is a way one can help. And what we know from our studies is that because when we're worried, we're all about ourselves. We can catastrophize within our own minds. But when we can rechannel that energy out to other people, whether it's giving money, giving time, giving your expertise, that can actually feel a lot more productive than the alternative. And then like very practically, by the way, I have another slide even, so there's more action here, is what we've talked about several times, is making sure that you've got sufficient liquidity or cash, that you are getting the best yield on that cash that you can. We're happy to brainstorm through your options on that. And it's especially, I think, important if you are not bringing in earned income, you're retired or not working, or you're concerned about volatility and know that you're going to need to access the portfolio in the next 1 to 2 years. If that's your situation, then we absolutely want to talk. We're already working with a number of clients to meet those needs at this point. All right, last set and then just some resources and we'll wrap up, see if anybody's got any questions. This is a don't. Trying to time the stock market virtually never works. And it doesn't work for the reason I said, is that that same fear that got you out of the market is the same fear that's going to hold you back getting in at the bottom. You know, we want to sell high and buy low, but unfortunately, we're not good at the buy low because buy low means things are not very good. Things don't look good right now. And we've had a couple of clients who were lucky enough to buy in 2009, but it was not because of any sort of strategic, intellectual timing. It was honestly sheer luck. One of the other things, you know, and this is a little out of our scope, but I think it's important to say because you may be looking at financial news as well. This is a time to stay informed as best as you can to understand what is going on, how you might be impacted, but it's also important to manage what you are taking in and where you're getting it from, and maybe to do a little more research and to dive a little bit deeper to see where that is coming from, maybe to double check what you're hearing. If it seems crazy, check it out at another news source. That is certainly helps with stress and then may also impact whether you take action or not. Last three, managing bond holdings. So one of the things last year for a number of our clients, we had extended their bond, mostly municipal bond maturities out to 20 years, thinking that interest rates were going to keep going down, which means bond values go up. It's an inverse relationship. But unfortunately, that has shifted with the election. At this point, we do not expect interest rates to keep going down in any significant way. This is a fairly uncertain time, and so we are working with clients to take their longer term bond holdings a little bit more short term, not to 0 or 2 years, but definitely to something shorter than 20 years. And so this is something that we are working on right now, that we actually are getting emails back from clients to take care of that. Social Security. So we have had some emails. Should I go ahead and start my Social Security? I'm in my 60s. Maybe I'm even at full retirement age. Omega told me to wait till 70 so I'd get the most money possible. You know, the standard rule of thumb is to wait if you can until age 70. And the thinking is that if you do that, first of all, if you will get 8% more per year on your benefits from your full retirement age till 70. That is hard to beat against the stock market. Maybe last year it was hard. It was a little different, but generally, consistently, year by year after year, getting 8% is hard to do. But there are a couple reasons why you might take your benefits earlier. If you don't think you're going to make it to late 70s, early 80s because of health concerns, because that's normally about the break even point, or
81, 82 is the most common break
yeah,
even.
we've seen late 70s with some clients. So, you know, somewhere around that. Or you really need the cash flow, then those are reasons we would recommend to take Social Security earlier. It also depends on if you have a spouse, if you would be the higher earning benefits. So there's a number of factors that are case by case. So whatever you hear from your friends and neighbors, it depends on your circumstances. There is not a one size fits all answer here. As we talked about earlier, if you do decide to take your benefits, you can ask for that 6-month look back. Now, you may not be able to pull that off online. So I'm just warning you that you may actually have to talk to the folks at Social Security. And that could be a problem because I think there's less people working there now. So that is something to think about, but I hope that if you're one of our clients, that you would talk with us first before you decide to put that in, and let us just work through what your options are, what might be the point at which you decide to take it. And then I have to say this, please contact us before you take any investment, work, or generally unreversible action. Please reach out to us. Let's do some scenario planning. Let us help you objectively think through all of the possible consequences, the tax consequences, cash flow, investments, all the different pieces. That's what we're here for. That's what we're trained for. We really want to help you, as Jared said, make an informed, educated decision that makes sense for you both in the short and the long term.
Can I say the line, Lisa?
Go
We
for it.
we can't unscramble the eggs.
Yep.
Once they're scrambled, they're scrambled. So let us know. Help us help you make the decision on how you want your eggs made.
Thank you very much for that. We've got a few resources, interesting, and I did not dive deep, so don't hold me absolutely to this, but if you're curious about deficit concerns, you might want to check into what the Peter G. Peterson Foundation is doing, depending on how you see this. Here's the LifeLock resource. Again, we're going to send these slides out so you can click these links. And then if you want to have an impact in the community in places that need it right now, Impact Assets, many of you are using their donor advised fund. Even if you're not, you can go check out some of the things that they have available, or that might be organizations or initiatives that you could be supporting that would help others who are struggling much more than we might be at this point. With that, Jared, any questions or comments we have from folks that we haven't addressed yet?
Oh man. All right. No new ones. So yes, we will send the PowerPoint slides afterwards. And yeah, now I'm reading that as I'm speaking. I'm seeing that she typed. Lisa answered as she was typing. So yes, we will be sending these out. Any other questions from anyone in the audience? If not, give it a moment or two. People typing. Um, Doesn't look like it.
Well, with that, I want to say thank you for so many of you who've joined us. I know this is a really challenging time. We really appreciate some of you being concerned about us. We have had more calls and emails than in prior uncertain times, and so that's why we decided to have this webinar. We have a brief newsletter coming out in the next week or so. We will absolutely be in touch with many of you. We are in the meeting cycle, so we will be going client by client through your situation. And as Jared said at the very beginning, do not hesitate to reach out to us. Let's get 30 minutes to talk through what your needs and your concerns are. We'd rather do that. We don't want you to be worrying or angsting about your situation and any action you feel you need to take. Anything else you'd add, Jared?
No, I think yeah, to your point, this is a fluid situation. We're learning on the fly like everybody else. So as things come up, as concerns come up, we will be available to you. That's why we work with you. So don't hesitate.
Thanks very much. Take care of yourselves. And we'll look forward to connecting with you.
Thank you.